I pulled up a LinkedIn post I thought was really helpful from Max Fryer. He is a business broker from Calder Capital, and I think he does a great job here of outlining, what add backs some lenders are likely to accept and which ones they're not. He says the hard no's, the things that lenders are typically not going to accept as an add back would be meals and entertainment, travel, personal phones, or if you're buying personal items on Amazon that is buried in the supplies cost of the business or something like that. And the reason probably that this is a hard no is that the SBA lender is going to want to document that these expenses are actually personal and discretionary and not for the business. And you can imagine how hard it would be to piece together, if you're buying stuff on Amazon, trying to determine whether that Amazon transaction is personal or for the business. That's a pain, right? Now, I will say in the comments of Max's post here, there was an SBA lender from a prominent bank that said, hey, we add back meals and entertainment all the time. We can make a case and our underwriting team is comfortable adding back meals and entertainment. So not every lender is exactly the same. As we kind of move down the list here, some of the things that are a maybe that might be added back, but you got to provide evidence. Things like if you are employing a family member or your personal retirement account as a seller, one-time repairs that are extraordinary. But if you look back historically, every year something's breaking down. Every year there's always some repair costs. And yes, that same thing might not need to be repaired every year, but something breaks. So this is why this is in the maybe category. And then things that are generally acceptable here, seller salaries, but he says adjusted for the buyer. And so what that means, let's say the seller is paying themselves $100,000 a year and the seller wants you to add that all back, right? Well, from a lender perspective, what the lender's trying to get to is how much cash flow do you have available to repay the loan? And they're going to look at this and say, well, hey, buyer, you are going to pay yourself $75,000 a year as a salary. And so we can really only add back the difference, that $25,000 difference between what the seller is paying and what you're going to pay yourself. Same thing with health and life insurance. I think, you can probably make a case generally that you could add those back. But as the buyer, are you going to have health insurance and life insurance? Are you going to end up paying for that? Is the business going to pay for that for you? Yeah, potentially, right? And so again, there's going to be a big difference is the point here. You could take a business that looks great from a seller's discretionary earnings perspective, but by the time the SBA lenders kind of gone through and said, nah, we're not counting that, the amount of cash flow you have available for debt service has been brought down dramatically.